My name is Charles Brown III, aka CB3. I'm a portfolio manager and financial educator, and I've been an investor for more than 30 years. As a portfolio manager, it's my job to keep our clients calm during difficult market periods. I did it in the crash of 2008. I did it in 2009 and 10 as a commentator for Fox News. And I did it in 2018 during the trade war scare. But 2020 was different. The pandemic brought a new intensity of uncertainty to all of us. When I began researching this week's show, I asked, how can I encourage them financially this week? How can I help them make their week more successful? That's why CB3 Live exists. We've been on 2 platforms in 2 cities with the goal of providing financial truth and a sense of calm about what's happening right now. Every week, I look forward to providing financial peace of mind to my clients and listeners. It's for this reason that it's a privilege every single time I start a broadcast by saying, from COVID, U.S. policy, and world economics, to clarity. This is CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, May 13th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you're with us tonight. Lots to cover. We have an inflation scare. Obviously, I'm saying that with a little wink because I don't believe it's one at all, but that certainly is what the media is telling you. And the states are revolting against these unemployment benefits. If you haven't read the story, it's a pretty big deal, and we'll get into that. You guys, we're going to handle questions tonight periodically throughout the topic. So when I finish a topic, start typing and I'll handle your questions just as quickly as I can. For those of you that are new to the program, please go to the YouTube page. If you're watching us on Facebook, if you're already on YouTube, then just click the subscribe button and hit the little bell so that you get notified whenever we go live. That's usually Thursday nights and then Monday for the Monday Market Mashup, of course. We also tweet on Twitter, and this week I was really on fire. Some of you got back to me and said, wow, it's nice to see you. Well, there was a lot going on Tuesday and Wednesday, which we'll cover in tonight's program, and that's why I was tweeting. I am there, and I am watching. I want you guys to know that, trying to bring clarity and peace of mind, okay? We're also on Facebook and LinkedIn, as I said earlier. So, the world economy, a little different order tonight for the program. So the market, guys, this is where we are at the end of the day today. The Dow is now the leader for the year. 11.2%, the Russell and S&P almost the same, and the NASDAQ just getting whacked. And this is bound to happen. I've been saying this is going to happen because in a secular bull market, we have to rotate. So what's the point? 2021 is about catch-up. That's the theme for this year. The other asset classes, that means the non-NASDAQ asset classes, are catching up to this huge move that the NASDAQ made last year, which benefited us to a great degree. You guys that are clients of ours know that our 2 growth programs, CG and SG, capital growth and strategic growth specifically, were up 62 and 63.5% respectively. But you know what? It's okay that these other asset classes are catching up because we have holdings in the Dow, we have holdings in the S&P and the Russell, obviously. So really, it's good, all right? Don't let it concern you. We want to continue this secular bull market. This is one of my favorite charts. This is from Tom Boley at Earnings Beats. Love this. The red highlights, and I realize now that I'm back to half screen, it's a little harder to see it, but just focus on the red. Notice that those are shorter periods of time. The returns are still positive during bear markets, but they're pretty small. But the length and the breadth of the bull market, which is the blue lines on the screen, are what we want to focus on. I believe that a secular bull market began on April 10th. 2013, that's when the high broke out here. If I could highlight it on the screen, you'll see that last blue line, and we're still just beginning that. In my opinion, we have probably close to another decade if history repeats itself. We're looking at a 100-year chart, and that's why I can confidently say that we're not going to sell in May and go away, even though that is a famous adage. To do so would be financially foolish, and here's why. Since 1971, look at these annualized returns for May, June, and July in the S&P and the NASDAQ. They are positive, okay? But this portion of the year, essentially this half of the year, gets a bad rep because, normally between November and April are when the really strong months are. But still, it is possible to have decent returns in this sector right here, of this time of the year, I should say, not sector. And last year, of course, it was a phenomenal return because we were just pulling out of the pandemic. Actually, we were still well in the pandemic, but we were pulling out of the bear market that essentially ended on March 23rd, or at least that was the low of the move. So you guys know this chart. This is still me tracking. We have 88% of the S&P reporting first quarter earnings. Remember, we're in the second quarter. We're reporting first quarter earnings right now, and 87% have beat. My favorite sectors of the 11 sectors in the S&P 500, consumer discretionary, technology, and communication services, have all handily beaten even the 87% number, which itself is far exceeding the benchmark average of 73% beats. All right, so if you stayed with me on that, 73 is the number that we're looking to beat every quarter. We're at 87 for this quarter, and the sectors that we favor even were higher than 87. So what in the world happened? Why did this market not appreciate that? Well, last year, during this time when we got earnings surprises, the market went higher on that. This year, it's done just the opposite. In fact, this is from the Bloomberg terminal. Tuesday and Wednesday were the worst 2-day selling back-to-back days in recent market history, going all the way back to 1991. I showed you a little arrow there. That shows the number of down ticks and actual trades that happened during the market Tuesday and Wednesday, and it was the worst period in 30 years. Now, there have been other down moves that have been more extensive than this, but this two-day period was just showing what a panic there was for people to get out of these growth stocks. And I think that's a huge mistake because there's always somebody on the other side of the trade. And the person on the other side of the trade is a market maker because they step in to provide liquidity in the market. So these people that are selling out of all these growth stocks, those stocks are being accumulated by the market makers. Who do you think has deeper pockets? I guarantee you the market makers do, and I think that bodes well for us, maybe not immediately. I've already handled market performance last week, and I want to just show you the graph here. We're not going to actually talk numbers, but this is what happens with CG. The blue line is the performance of capital growth this year. You'll notice that it ramps up and down. So in February of this year, it was just clobbering the market indices, and then it went down, it came back and was marking it, came back in April and almost caught up with the S&P, and then now it's just really having a bad time. But guys, this is normal market behavior. All right, anytime you have a program that is mercuric, like this is, like Mercury, okay, it's going to have this kind of volatility, and strategic growth, the next chart here, is the same way. Again, the relative dollars I'm not really focusing on. I just want you to see what the ballistics are like. And actually, I think I clicked twice. Yes, that's DG. Let's go back to SG. So you see the same kind of, it's in different places. Most of the year, SG is beating the markets, but it's just taken a real turn here as the panic sell-off in growth stocks has continued. I showed you that on the previous chart. You can see all those negative ticks. I do not expect this to continue because, again, somebody is buying those stocks. You can't just sell to a machine. Somebody is buying them, and the person buying them is buying them in a down market, okay, which means they have the courage to step up and buy when everybody else is selling. All right, and those are going to be deeper, stronger pockets from my experience. This is diversified growth. It mostly has tracked the market, although it's fallen back in the last couple weeks here or so, actually more like 4 or 5 weeks. This is GI, which is our best performer. Now, those of you that have GI accounts were calling me during this bull market rush last year that started March 23rd, but certainly took off around this time, which means sell in May would have been a terrible decision last year. And GI just had a tough time competing with our growth programs. But this year, it's actually beating the market. And that's the way that favoritism between different asset classes rotates, guys. And I just want you to fully embrace that that's just simply normal. Now, does that mean that you should switch your CG or SG account over to DG or GI? I've had a few calls on that this week. First of all, the answer is no, not right now, because CG and SG need to bounce back, and they will. Now, if you have felt too uncomfortable during this recent downturn, which by the way is not even close to what the downturn was in March, just 2 months ago, but what do we have going on here? You've been hearing me talk about recency bias. So what's happening right now just seems like, oh, the world's coming apart. But just go back and try to remember how you felt in March. I wasn't getting any calls then, but I'm getting them now, and I'm telling you, we don't have a problem with the programs, all right? The programs are delivering, but we may have a problem if you're a client with the volatility that you're experiencing. You may not be comfortable with it right now. And it's very easy to switch to a less volatile program. You can see what it looks like on the chart, okay? I want to just I usually cover the stocks that are just doing great, but here's one that Trade Desk is in, Capital Growth. We got in at 286. It was at 501 today, so we've got a pretty decent gain here. But the stock, look at the volatility on the bottom. We had a 100% gain in this stock just before Christmas. Now, if I had known that it was going to go down, obviously I would have just sold it then and bought something else, but I didn't. So if you've held this stock for 5 years, you have a more than 2,000% gain. 1 year, 55% gain, 3 year. If you bought it in December, you're down 50%. Okay, that is the ballistics. That's what it means to invest in a aggressive growth program like Capital Growth or Strategic Growth. There are other asset managers out there that have far greater losses these last 3 months than we do, because I wouldn't say I'm, at the full extreme of being an aggressive portfolio manager, but these two programs are aggressive. So Trade Desk has been a winner for us. I do believe that it's going to go back up and test those highs again. In fact, I wanted to put this chart in here. This is the chart on a monthly basis of Trade Desk. We bought it. You see the green line? That's where we bought it. I kept the prices off of here so it didn't confuse things. And look how it just rocketed up. So it was a great call. Well, some bad news came out. You see this huge red bar that has now, not dropped back below where we bought it. Obviously, that's why we still have a profit. But this sort of behavior is common for growth stocks. Think Tesla, think NEO, think Zoom. There are plenty of other stocks that have this kind of ballistic behavior. This is a typical stock for CG and SG. All right. All right. Anybody got questions here? I'm going to pause just for a little bit. Hey, David James, welcome. Good to see you. All right, Mark, I know we're like 20 seconds behind here, so I'll watch for questions in the sidebar here. But I want to move on to economic indicators. Those of you that are new to the program, economic indicators are what set up my opinions for future investments. So the market says, here's what's happening right now. Economic indicator says, well, here's what's happening, but they're not really leading indicators. They're saying, here's what's going on, and down the road, that's going to influence how portfolios should be managed. At least in my opinion, that's how we do it. So non-farm payrolls, this was a huge shock. So every third Thursday when I do my program, or second Thursday, I should say, the previous Friday has been the non-farms payroll. So the first Friday of every month is the non-farm payroll. There was an expectation, look in white there, of 1 to 2 million new jobs. The Biden administration had gotten very confident in this, and they were ready to have this big party and press conference. And what happened? 266,000 jobs, the single biggest miss in history. Not only that, the unemployment rate was higher. Not only that, they went back to March and revised that down to 770 from 916. So it was a double loss. Now, I am not naive enough to say, well, that's because of the Biden administration and because of their policies. He hasn't been there long enough to say that. But clearly, there are issues with job growth in America, and I'm going to cover that in this program because I have my own opinion, and I don't think it entirely relates to the Biden administration and their policies. The key takeaway from this report is that the net jobs gain was negative. If you take out leisure and hospitality, which finally is getting some traction to the upside, they added 331,000. Take that out and everything else is negative. It was a stunning slowdown from March. And now people are saying, is it these extended unemployment benefits that are just keeping people from going back to work? If you recall, 3 weeks ago tonight, I was trying to get an Uber back from a place in Nashville and my phone came up. You remember the message? I'm looking at my phone and going, no cars are available. Now, I've lived in Chicago for 38 years, and I never saw that message. Obviously, for most of those years, there was no Uber, but I could get an Uber in 45 seconds. I would have been happy to have an Uber in 20 minutes here. And this is a pretty big city. It's 1.8 million people. All right. But no, there's none. And when I finally got my driver, he said, nobody's working. They don't want to work. They just soon stay home and get the checks. Well, we're going to deal with that. So this miss in the unemployment number has increased this debate about are people being disincentivized to work. And this is a big issue with me because when the government is interfering with private enterprise, that's a huge problem. And that tends to happen with Democrat administrations. What do I mean by interfere? If you are paying someone to stay at home more than they have reason to think that they can earn, they're going to just stay home and live off the dole. And they're going to be very appreciative of you making that possible for them, and they're going to vote for you. And that's exactly why administrations do that. It's not just the Biden administration. There are plenty of others in history that have done the same thing. They're trying to build a voter base by continuing to pay people when they shouldn't be paid. They should be out looking for work. All right? So, unemployment benefits. This is the issue at hand that has me so concerned. So, more and more states are rejecting this extra $300 payment for the unemployed. So the federal government is saying, we've got all this money. We're printing money. Understand that no one can print money. Not a city, not a state, only the federal government. And they just crank it out. They used to call it with Ben Bernanke, Helicopter Ben. He would just send out money with his helicopter. Of course, that was a figure of speech. But the point is, that the dark states here have higher unemployment rates and more people staying home. The lighter colored states have lower unemployment. All right. And they don't want to have all these extra benefits coming out and being made available to their population because it disincentivizes people returning to work. They can say, oh, I'm scared of COVID or I don't have child care. Well, you had child care a year ago. Where did it go? All right. And I understand that there are some complicated situations where some people don't have that same child care. The nursery programs have not reopened. I get that. But basically, this started in Montana with their governor saying, we're going to refuse the no work bonus. And then it moved on to Florida, where he's one of the best governors in the country, in my opinion. Ron DeSantis said, you know what? We don't want it. We're not going to offer it to our population. Then the South Carolina governor joined in and said, we're ending the federal COVID-related unemployment benefits. And finally, our governor, Bill Lee here in Tennessee, said we're opting out. We're not going to offer it because many Republicans in this state argue that these additional funds allow low-wage earners to make more money staying at home. That is bad for the economy. That is bad for the workers. It is bad for business. How bad is it for business? Am I just on a pedestal here or, what am I trying to say? A pulpit just yelling for no reason? No, there is a definite issue. Someone on our chat last week, and I forget who it was, said they went into a restaurant, hardly could get waited on because the one waitress that finally came over and said, we just can't get people to work. So we're all working too many tables. The service is bad. And here we desperately need to get back open. Restaurants have been closed for 12 to 15 months and we can't get people to work. Here's a guy, restaurants ready to hire, but government payments keeping workers home. Literally today at my property, we have a landscaper coming out to help us with some issues. And he said, I literally, as the owner of the company, I'm out mowing yards because I can't get enough people to work. And we're offering them, he went through the laundry list of, benefits and personal days off and use of a truck and helping them get, into junior college, all kinds of stuff. And you're going to see here on the slides. I mean, this is happening everywhere. And yes, for those of you that have been watching me for 14 months, this is the first time I've ever used a video clip from CNN. So don't diss me too much for that. But I thought this was great. This guy is luring people back to work by offering reimbursement for college tuition. We're not talking, high-level white-collar jobs. These are just jobs that are, in the service industry, but they can't find people to work. So this is how they're having to incentivize them, okay? Love this sign. If you take a job at McDonald's, $500 sign-on bonus, payable now after 1 month. So you can't just, get it and then walk away. But if you've been there for a month, you get your $500 sign-on bonus for making Big Macs. What a life. Never thought I'd see this in this economy. So what's happening? This is data from Fred, and those of you that don't know, Fred's last name is not Flintstone. It's the Federal Reserve Economic Data, okay? I want you to look at the previous 2 recessions and look at the number of job openings going down. That typically is what happens in a recession. There aren't enough jobs, okay? So the job openings go down because there's nobody hiring. Look at the 2008-2009 recession with the gray bar there, and the job openings just plummet. But look at the exact opposite in the most recent recession, which is now technically over, okay? We are at lifetime highs in job openings, okay? It's just incredible. It's something I never thought I would see, but it's the reality of our economy right now. Job openings, this is an actual data point. The survey was 7,500 for March. We still don't have April's data yet. But the actual amount, and this is in obviously hundreds of thousands, the actual number was 8123, 8 million, because you had 3 zeros after it. Just almost unheard of, again, in a recession or just pulling out of a recession. Where are the areas where this is happening? Production, manufacturing, loading, stocking, childcare. We had Lydia Thibodeau on here a couple months ago, and she told us that literally could not find a nanny to fill a position for $125,000 plus medical benefits and everything. Just crazy. And even hospitality and tourism is catching up. Okay, it's going to be back to the zero line, but the problem is you can't find people to work. So here's my take on this, and I saw this quote. Over the years, the refrain of businesses complaining about how hard it is to find workers has become a little bit like the boy who cried wolf, except that this time the wolf actually may have arrived and he's asking for a fatter paycheck. We'll see. We'll see if that's what does it. Is it just going to be throwing more money at these workers to bring them back? I don't think so. I think it's going to be the ending of these COVID unemployment benefits, which are, we're supposed to have a safety net in this country. And when businesses are having to compete with the federal government for workers, and I don't mean that the government's hiring them, you know what I mean, because we've just talked about this. The government is saying, we're going to pay you to stay home. We want you to love us. We want you to appreciate us making life easier for you. That's competing with independent businesses. And that is absolutely harmful to the U.S. economy, in my opinion. Feel free to weigh in. We're going to talk about inflation here. Let me check the chat. Appreciate you saying that, David James. No optimize on the market or in business. Too much government interference in daily activities. Absolutely correct, Mark. No question. We're not talking to new technology or innovation anymore. I'm not going to totally agree on that. Actually, Mark and I had a private conversation on this too. I still see technology happening. I'm seeing IPOs. I mean, it's not like the IPOs, initial public offerings, have dropped this year in the market. There's still an interest in innovative ideas, but the current administration is not really interested in business. And the reason I can say that is when we get to the policy section, they're looking at promoting or producing essentially the highest corporate tax level in a half a century. This current administration is not friendly to American innovation, and that is a colossal mistake, in my opinion. It is not good for the economy. It's not good for the American worker. It's not good for creative input. Just like Mark is saying, we're not talking new technology. I do believe that it's not dire that we're just not doing it, but I think it's less. I'm still encouraged by the number of IPOs, okay? I was in a restaurant, says Tommy, one waitress for the entire restaurant. Oh gosh, running ragged, not getting anything. And probably because she wasn't giving good service, Tommy, she probably didn't even get much of a tip. And so then she gets discouraged and says, well, I might as well stay home like everybody else. The government is supposed to be, in my opinion, protecting our borders, fixing the infrastructure, which the previous administration didn't get done. Yes, that's you, President Trump. Should have gotten done when you controlled all 3 branches. Didn't get it done. And now the Democrats are going to try to get it done and put all this pork in it. But that's what we need is infrastructure. We need our borders protected and then leave the economy and the business of America to the business of America, instead of meddling by tampering with all these benefits that are unneeded. I don't even know, when you see these numbers I'm showing you, do you really think we need a $2.5 trillion stimulus package that nobody can pay for? No, we don't. All right. Is that not a move to socialism? Well, yeah, that's exactly right, Kay. And I appreciate that email you sent me this week, Kay, by the way. I'm going to show that the Salowinski, the 8 points. I didn't have time in this show because there's just so much to cover. But we'll cover it next week with our special guest. And I hope you guys will be there. I'll have a little notice at the end of the program for that. But this is kind of an educational section. I haven't done this in a while, but I want to talk about inflation. This just kind of school you a little bit because everybody gets scared about this word inflation. So what happened when CPI came out? Well, CPI numbers were roughly double the highest estimates. And that's the yellow bar that you see on the screen. And you can look back to 2018 and see, okay, clearly it's higher. But what I want you to look at this, the most right bar, which is high yellow bar. Look back to April of last year and see that it's negative. Well, if we had deflation, which is negative inflation, and we have inflation this year, if it's really not that bad, it's 3.5%, 4%, it's actually 4.25%. Obviously on an annualized basis, that's higher than you want it to be. But what makes it look so dramatic is that it's a contrast to last year. And this data is always looking back 1 year. As someone pointed out today on Bloomberg, a year from now, it's really going to look pretty good because we got a 4.25 number. And, April of 2022 is probably going to be 2%, something like that. So everybody's going to be feeling good again. So these are anomalies. That's the takeaway for you guys on this section. Don't listen to what the media is telling you to try to get you scared. Okay? They're trying to get viewers. And they're doing that by scaring you about inflation. So what's one of the culprits for what is raising prices? Used cars. You guys know that consumer discretionary spending, those of you that watch my program, is the number one driver of GDP, gross domestic product in the United States. Okay, 2/3 of all GDP is consumer spending. The other 1/3 is divided between government spending and corporate spending. Look at this bump in cars. Well, people are buying homes. I've been covering homes now for 6 months. I'm giving you guys a break. I have no home stats in the show tonight. But, used car, just crazy. People are saying, I've got this money. I'm getting these stimulus checks. Time to get a new car or to go out and get a used car. And that's a positive. Last month, posted the biggest annual gain since 1996 on core inflation prices. So look at the yellow on the top. That's what we're looking at on the graph. All items included. So if you exclude food and energy, that's the orange line. But when you include everything, and that would include homes, that would include cars, things that, bigger ticket items, refrigerators for the home, etc. We are seeing some inflation, but guys, it's just not out of hand, first of all. And second of all, it's transitory because it's going to move back to a more common level. What the Federal Reserve wants to see is 2%. I'm going to quote a couple of Fed guys here in just another slide or two. So where is it in the economy that this inflation is happening? Realize that when people say inflation's going higher, that's like saying, well, the sun is shining. Well, here, Alaska, Antarctica, Iraq, it just depends, okay? So inflation can be happening in different ways. And again, we're going to dig into this in just a minute. But airline fares, I'm glad to see inflation. First of all, we have a daughter that works for American Airlines. And I want her to keep her job. And frankly, I want the airlines to stay in business because after not traveling for, a year and a half now, my wife and I are going to do some traveling this year because we want to see our children and grandchildren. So the fare's a little bit higher. I'm okay with that. I want these airlines to stay in business. Admission to sporting events. I'm not a big sporting guy, but I certainly want to see that aspect of the economy continue. Used cars and trucks. We just looked at that data, public transportation, etc. These are items that are gaining traction, no pun intended. And doesn't mean the inflation's off the rails or anything. It just means that we are starting to see enough buying interest that it's driving prices up more so than just languishing, which they did for literally 15 months. So this is a quote from one of the Fed chairmen. You guys know that there are 12 different areas of the Federal Reserve. Jay Powell is the chairman of the Federal Reserve, but each of the 12 districts has a vice chair. Okay, and they offer opinions and they have commentary. It's not as important as what Jay Powell says, but they do have some weight. Okay, and this one is saying, take some time for substantial progress to be achieved. In other words, we're not really concerned about this level of inflation right here. So the readings on inflation year over year have recently increased and are likely to raise somewhat before moderating. So this bump that's happening is not something that concerns this Fed chair. And Christopher Waller is another Fed governor, and he said this today: the factors putting upward pressure on inflation are temporary. This is one of the reasons why the market rose today. These Fed governors and vice chairs can move the market, not like the chairman of the Federal Reserve can, but they still can move the market. And when people saw this and that the Fed is going to continue their accommodative policy, not pressure, accommodative policy. And they're going to continue to play an important role in supporting the recovery. The Fed is backstopping this recovery. They realize this pandemic could have just absolutely crippled America. And we're going to look back in history. That's another topic for another day. And could have handled this much, much better as far as shutting down businesses. But be that as it may, this Fed governor is not concerned about it. And because these two guys are not concerned about it, I'm not concerned about it. All right. So I want to just spend probably 6, 7, 8 minutes here on explaining inflation, because part of what we do here is education. Part of this, there's only two people that watch our show. One, you're a client. Or two, you want to have an education because your financial advisor doesn't do this for you. And that's fine. I'm glad you're here for that, okay? So what I want to do is explain what inflation is. It's not a simple topic, okay? And this isn't like the total, Wikipedia version here, but it's something. There are 3 types of inflation, and you need to understand the difference between them. Monetary inflation, okay, refers to an increase in the money supply, such as M2. What does that mean? Okay, so there's M1, M2, M3. I'm not going to go into the detail, but imagine a pipeline that can carry oil, or even electric lines that can carry a number of amperes of power. Okay, if more gets pushed down the line, that's inflating the amount of electricity or oil that's available in that pipeline. That's what monetary inflation is. So it's not about the price, it's about the velocity or the amount of money in the financial system. This actually is a good kind of inflation. We want to see money pumping through the system. What happened in 2008 and 9 is it shut down because of fear. Okay, so this is good inflation. All right, so now is the one everybody knows about: consumer price inflation. So what is that? When a nominal, and that means non-inflation adjusted, but a nominal basket of prices increases, a nominal basket of goods and services, I should say. Okay, so here's an example. Let's say you pay $4 for a Big Mac 5 years ago and $5 this year. Well, that's a 25% gain. Okay, but it took 5 years to do it. So if you do the math on that, that's really only 4.5% inflation, which is higher than the general economy. So that's why at any given time, there are multiple different inflation rates going on in America. Some items are inflating more than others. For instance, let me give you an example. Which do you think is inflating more, college and medical tuition or clothing? That's a pretty easy one, okay? And why is that? It's all about supply and demand. Now, higher education may be in for a big shakeout after this pandemic, and many people realize, hey, I don't know that I need a college degree to be able to work, or I can get an online degree, which is just as useful and maybe less expensive. So that's also shaking out. But so as relates to consumer price inflation, the difficulty, of course, with this measurement is that you have to agree on what the goods and services are. Okay, and we're going to get to the little example I give you at the very end here. We can obviously cherry pick, and this is what administrations do. This is so funny. If it's the Democrats and the CPI comes out where they're going to pick the numbers that make it look good for them, and the Republicans do just the opposite. Okay, it's just the way they are. And are they lying? No, they're just cherry picking. You guys know what that means. They're cherry picking the data that they want, which is why I'm trying to give you clarity on this. There are many components, which is why when you hear people talking about inflation, step back, take a couple breaths, and realize, okay, let's really dig into this and see what does this mean for me. So Consumer Price Index, another example here. If you have this basket of goods in 1982, it's $100, okay? But today, it's $265. Well, in 1913, it would have been $10. So what that means is that's a 26-fold increase from 1913 to today. Now, you might say, oh, gosh, no wonder I'm not getting ahead. Well, that all depends. If you have a salary, and not that you've been alive since 1913, but if you had been alive that long, and you had a salary that had grown at a 30x, you would be just fine. If your home value and your stocks and bonds and whatever else investments you have, gold, precious art, had grown at 28 to 30 to 32, you'd be just fine because you're keeping up and actually bettering inflation. But if you have a job that doesn't give you the ability to have pressure upward on your wages, and you're only keeping up with inflation at a 20 times, really, you're going to be falling back year after year after year. And we see this in society. I don't believe it's government's job, by the way, to fix this for people. I think it's people's job to understand what they're doing to earn a living for themselves and their family, and to make sure that what they're doing has upward potential to keep up with inflation. This is the data that you need to know to understand inflation. The third of the three is asset price. Now, this is what we think of, valuations of financial assets like stocks, bonds, real estate. I want these to increase. You might be saying, well, why don't we just have asset price inflation and no consumer price inflation? That's sweet. That'd be great, wouldn't it? It doesn't work like that, okay? But ideally, we want our home price to increase. We want our stocks to increase. We even want our whatever car we just bought to increase, but we know that's not going to happen because depreciation is involved. But these are real assets, and we want them to appreciate over time. That's the goal. So this is kind of a complicated graph, but just look at the blue versus the red. So the percentage of GDP is in blue, currently about 600%. Versus the left axis, and short-term interest rates. So you're seeing the net worth of Americans rise. Why? Because interest rates are going down. This is really important, okay? So just follow me with the blue and the red here. You hear savers saying, we can't get ahead. We're putting our money in savings account and we're losing purchasing power. You are. Don't put your money in savings accounts. Well, but we're at retirement age and we can't take that risk. Well, then you're going to get behind inflation. Part of the reason why the stock market has had such a great growth from 2013 and arguably way back before that, 2000, with obviously the big dips that happened in 2000 and 2008, is because there is no better place. Okay? TINA is the acronym. There is no alternative. You can't get it from bonds. You can't get it from cash. And that is part of what's driving the stock market. I don't see that changing anytime soon. I just don't. Okay. Asset price inflating. All right. That's a good thing. All right. So I'm going to give you a couple examples here. If the government and the central bank, so that's the Fed, were to create $1 trillion new dollars, which they do all the time lately. Shouldn't be, but they are. And they gave it to 100 of the richest people in America, other than having an enormous outcry from the Democrats. What would those people spend it on? Well, all their physical needs are met. All right. They don't have any desires that they can't do because they're already wealthy. They're not going to eat better. They're not going to travel more. They're not really going to do anything differently. So they're going to take that money and they're going to invest it in stocks and real estate and in other assets. And if that were to happen, aside from the outcry from all the Democrats, and I'm not saying it's something we should do anyway, but the point is, what would happen? Asset prices would increase because all these new buyers would come in. But it wouldn't really affect copper and beef and other consumer items. Let's look at a different example. All right, if the government and the central bank, the Fed, said, well, we're going to give $5,000 to every American adult who makes less than $1 million. That's most people, including me. About 200 million people, $5,000, there's $1 trillion, all right? So instead of buying those, they wouldn't buy the assets, they'd buy consumable items, probably like food and clothing, entertainment, pay down debt. Okay, that wouldn't push up the price of assets, but it would increase the price of beef, clothing, gasoline, etc. You see why inflation is not a super easy topic. And when somebody says inflation is rising, you just need to immediately discount that and go, what does that mean? What are you trying to say? Because some inflation, I've shown you 2 out of 3, and as we know, Meatloaf said 2 out of 3 is not bad, all right? We like asset price increasing. We like monetary policy increasing. We don't like consumer prices increasing unless the other two are keeping up with it or improving on it. And it's our job to understand how we function in that as a human being living here in America and make sure that we're keeping up with what is going to happen whether we like it or not. All right, I know that was kind of wordy. I'm going to pause here for a minute and actually get a sip of water and a fresh cough drop and see what I've got in the chat here. All right, David James had to hop off from an okay. In light of our conversation, I had a good thing between, had to get a point. Okay, well, guys, that was a lot on inflation. Any questions at all? I know we're like on a 25-second delay here. But it seems to me that it's important that you understand how inflation can affect us, how inflation does affect us, and also how it doesn't affect us. Okay? There are a lot of factors going on here. And if you have questions about this, you know I'm at cb3@cb3.com, or you can give me a call. So undoubtedly, a lot of drama here this week. You've heard of this security breach with Colonial Pipelines, okay? So there was this ransomware attack, and it's actually more prevalent here than in most of the other developed countries. Look at the number of ransomware, occurrences here. And, it definitely affected different parts of the country, on the East Coast especially, where the gas station is just out of gas. It's not an issue here in Tennessee or, my former state of Illinois, but definitely down here. Look what it's done to gasoline. The thing is, this was preventable. And this is my opinion. I can't support this with any data, but these guys at Colonial Pipeline actually advertised for a cyber manager before the hack. They put an ad on LinkedIn or went out in the job search entities and began searching for this cyber manager. What in the world were they thinking? Don't you know that the criminals are looking for that? That'd be like me saying, I'm leaving town on vacation for 6 weeks. Please respond to this if you're an alarm company and you can help me get set up. We'll do it while I'm gone, so I know my house will be unguarded for a short time until you come in and install your system. It's probably not quite that bad, but it's close. All right, so this was just poorly handled with the assumption that everything's going to be fine, and clearly it was not. All right, so they're almost half of the oil on the east part of the country. If we had been in the stock, it would have been a really bad thing, obviously. So I think this is a wake-up call for entities that there are companies, the Dark Side is their name, and I guess they call themselves a company. They're really an espionage company, but their goal is to wreak havoc on systems throughout the world. And as a portfolio manager, we need to be aware that cybersecurity has never been more important than it is right now. And we actually invest in some cybersecurity companies. So, but be aware that even drivers are staying off the road. So I had one of my children is in logistics and sent me this information, basically truck drivers staying away from these impacted areas because they're scared bringing oil in, if they're having to bring it in via truck rather than on the pipeline. Of being attacked. I mean, they're making TV shows now where they're, ripping the driver out of the truck and shooting them and then stealing the COVID vaccines out of the truck. It'll be the same with a commodity. Anything that has value, and it has value over its normal value when there's a disruption like this. These are the sort of things that make a job for a portfolio manager tough, because it's really hard to predict, especially if you're invested in this area. But we keep up on it, do the best we can. This is the area affected across the U.S. here. So, maybe you've been affected. If you have, write it in the chat box here, and I'd be interested to know. So, all right. So this is interesting to me, the 10-year threat shift. So obviously what we're doing going forward to invest in this country has changed with COVID. We know that. I think I've also relayed to you that the biggest change and concern is with the powers in this country that want to turn this country into a socialist entity. Okay, and it is very real. We're going to talk about that extensively next week when I interview Leo Klenstein, and he tells us about his escape from Russia and what it was like to be in a communist country and to come here, and the enormous changes. It wasn't just socioeconomic, but many, many other things too. But if you look 10 years ago, Afghanistan, Kabul, Iran, Tehran were the biggest threats, or perceived to be the biggest threats to America. That's changed 10 years later. You can see at the bottom, 87, the number of times mentioned in this particular security bulletin. China, Beijing, Iran, Moscow. I mean, these are people that want to hurt America. They can make friends and go up to Anchorage, Alaska, like they did, weeks into the Biden administration, which that was a colossal mistake of a meeting, and say that they know we need to work together, but that's just not true at all. These countries want to dominate the U.S. economy. They want to dominate the U.S. people. They want to replace our democracy with their imperialism. And if you don't believe that, you think China just wants to work with us and not actually try to dominate us, that's not true for a minute. Khrushchev said to Kennedy, "We will bury you." And this was half a century ago. And if they could have done it, the Russians would have done it. All right, let me see if I missed anything. Thanks, Tom, for the great word there, explanation on inflation. Thanks, Doc. I appreciate it. I was able to get gas today with no problem. My wife was waiting in a line here. I think she said there were 28 or 30 cars. And we don't even have a pipeline issue. But this is what happens when people perceive. They see it in the news. Oh, you better go get gas. Well, there's your map, okay? It's going to be fine. It's going to be fine. We'll see an increase 75 a gallon. Well, part of the reason that we have this inflation, thanks, Kay, with gasoline prices is because this administration basically has stated we're going to have a war with our oil companies. I mean, the day that Biden took office, he shut down additional permits for the Keystone Pipeline. How is that good for America? How is that good for investors? How is that good for jobs? It's not. It's negative all across the board. I understand it's good for the green folks, but that's not what we need in this country at this time. We have a lot of jobs that got wiped out, and basically a bunch of people in Montana have said, you will never, ever elect another Democrat, senator or representative in Montana or North Dakota for that matter, wherever the pipeline is a key and essential part of the economy of that state. So, all right, COVID. Last time I'm showing you this. We're done with COVID, okay? Daily cases way back to where they were a year ago. I called it right in January. That was the peak. Actually, it was December, but when that little spike happened in there, I said this has to be it, and it was. So we are moving on, folks. We are now in the recovery section. Look here on the chart. TSA checkpoints. I mentioned this earlier with flights with American, and this is good because we have a daughter that works there, but good for you guys because you want to be able to get flights. My wife was going to see her parents, and she always had to take the last year 2 flights to get down to San Antonio. Well, now they've reinstalled direct flights. Why? Because they have enough patrons on the planes to be able to put back some of these direct flights that everybody wants. Look at the chart here, the dark blue line. You'll see that 2021 is already far ahead of where 2020 is, and it's heading back to where 2019 is. All right. And that's what we want to see. We want to see this recovery. Why are people coming to the U.S. to get shots? I love this caption. Because we have the shots. Because we are the country that came up with this. We're the ones who are inoculating our population at a dramatically higher rate than any other nation in the world. Why is that? Because we incentivized our big pharma to process and make this vaccine, make it available, distribute it, manufacture it, and the rest of the world didn't do it because they don't have a government in place to incentivize their big pharma to do it because they're too busy trying to get people to be supported on the dole. They don't have a capitalistic motivation for excellence, which is indeed what we have here. So if you wonder why people are flying in here, you don't see Americans flying anywhere to get vaccine, do you? Of course not. We are the leader by far. Moderna now says they have a booster shot. Now, this is where it's going. We're all getting these jabs in the arms and waiting in these lines, like at least we are here in Tennessee. But soon, I think this is going to be blended into an overall flu shot, the same thing that we take every December. And now their booster is showing promise against the variants that you've been hearing about. All this is positive. All this is possible because of American innovation. I'm not an investor in Moderna right now. We were for a while, but I suspected because of what Biden was saying in the summer that he was all for stopping or at least, preventing the full acknowledgement of these patents. Okay, I mentioned this last week. I'm going to get to this in just a few minutes, but I just thought there was risk in big pharma, so we've been aside from this. We talk about politics because politics leads to policy. Policy has portfolio impact. Very, very important. And when you see this on the screen for the Wall Street Journal, this is actually live on CNBC. This is the tax proposal that the Biden administration is proposing. So you have to go back to the 70s. Nothing even close to it. I suppose, you go back to the early 70s and Johnson and Carter, drops, of course, with Reagan, picks up a little with Clinton, drops again with Bush and certainly with Trump. But there's just nothing good about a tax rate this high. Absolutely nothing. It's meant to redistribute the wealth of this country to those that are in power and want their voters to be recipients of this because they think that it's a woke society. And, I don't even want to get into all this. It's really hard for me not to do it, especially living where I do now. But the reality is that there is nothing positive. This is a financial show. There is nothing positive for us from a financial investor perspective about a tax rate that's this high at the federal level. At least here in Tennessee, I don't have a state income tax anymore. 48 years in Ohio, Wisconsin, and Illinois, I paid state income tax. No more. But this federal tax rate is going to do nothing but stunt growth. And I do not believe it will pass. Fortunately, we have enough votes in the Senate to keep that from happening. I railed on this last week, the Biden administration saying they're going to ease protection for COVID-19 vaccines. I think it's a colossal mistake. I was really angry about it then. I still am. But I'm going to give you now, as best as I can, an unbiased assessment here. Well, I'm probably still biased. But here's the case against IP suspension. That means intellectual property suspension. So a large number of pharma companies, they're saying that if you waive these rights, it's not going to solve any supply problems because if the folks have the patents and they can go in there and figure it out, how are they going to actually produce this? Do they actually have contract producers that have the familiarity, the skill set to make these shots, to refrigerate them? Remember, most of these shots have to be kept at super cold temperatures to be stored, to be shipped. Think how many millions of doses have been lost because they weren't able to be stored correctly. There are all kinds of obstacles to scaling up because these companies don't have the trained technicians and they have scarce ingredients. Quality checks are another concern. I mentioned this last week, that what happens when these patents are just essentially waived, other folks come in and decide their own government in their country incentivizes them to use a U.S. patent. They produce it with problems and then cause illness and sickness and death for their own people because of the vaccine. And then they come back to the original patent holder and say, you're the problem. Can you imagine that? Talk about no good deed goes unpunished. So what's the case for suspending it? The only thing that I can see, the proponents of this say that there are more than a dozen drug makers in developing countries that could be equipped to produce these shots and have passed quality checks by the World Health Organization and the FDA. Well, I don't really give a rip about the World Health Organization. I wouldn't trust them as far as I can throw them. It's a political entity, and they're not at all concerned about the theft of these patents that they're taking. Okay, it would allow nations to make their own copies of vaccines, but with all the issues and problems that I just mentioned. I think there's a better way to handle that. So what's my biggest beef? Entities with little or no experience in manufacturing are likely to chase the very same raw materials that the companies themselves that created these patentable vaccines are trying to procure. Okay, they know how to scale production. You guys are seeing literally hundreds of millions of doses. And we're going to give this to some second and third world countries and see, well, here's our patent. You can use all the information. And they're just going to miraculously be able to do what Johnson, Moderna, and Pfizer can do, putting the safety and security of all of us at risk. It's just a colossal, colossal mistake. And I'm embarrassed to think we have any administration in America that would do it. For those of you that are on the conservative side, you can say that, I've been talking about this for the last 4 months. The redistricting is in, and Republicans at this point, at the state and local levels, have a pretty significant advantage as far as redistricting. That affects who does the voting, and this should affect how the voting comes out in 2022. Okay, so post 2020 redistricting, because now the census is done, will first affect the 2022 election, and then, of course, the general election in 2024. Let me pause just for a second here before I go into crypto. All right. Hey, Kate, how are you? Vaccine tourism. Yeah, that's exactly right. All right, crypto guys. So Elon Musk went on Saturday Night Live and, in my opinion, bombed. I had to turn it off. It was so bad. I don't know if any of you guys watched it, but dude, do not quit your day job. You're really good at your day job. You have 2 of them. You make cars, you put people in outer space. You're so good at that. Please don't go on TV again. And then don't go on the Twitter and say, well, we're going to stop Bitcoin. It's kind of a not really green efficient way that they make these Bitcoins and they mine them, and it's a problem. Really dumb. But it also reveals to me that this asset class called crypto is still very much in its infancy. Anytime some guy like Elon Musk can tweet something and Bitcoin drops 15-17%, yeah, that's not something you guys want to be messing with, except in very, very small doses. So he says he's no longer going to accept it. He walked this back later in the day and said, oh, we still believe in Bitcoin. Well, it's all being shaken out right now. So an asset class to know about. Why? Because look at the amount of cryptocurrency in circulation versus the amount of dollars. This is a percentage of growth. I mean, it's something that I cannot ignore as a portfolio manager. And that's why I cover it. So don't feel like you have to rush out. There is plenty of time to participate in the cryptocurrency asset class development. All right. And the reason I do these segments is because of when we did a little survey a while back, people said, don't ever have a program that's a double negative without a crypto section. So I'm doing it. There's always something to talk about every week. I've been advertising this now, so a week from tonight, Leo Klinstein, what's it like to actually live in Russia and escape to the U.S.? It's just going to be a wonderful interview. Guys, come with your questions. He's happy to answer them. Really looking forward to seeing Leo. Here's what we covered tonight. If you've got any questions, type them in now. We don't always cover every topic, as you can see. We didn't do anything on the Fed or housing tonight. Energy. Next week's going to be investing in post-COVID America, because, again, it's my opinion that the biggest risk that we have is way more political than it is balance sheets or inflation numbers. I mean, obviously those can move the market. But if we lose the fundamental premise of being able to invest in a free market capitalist system, that is by far the biggest risk that we have and could turn us into Venezuela in another generation. I don't think it's going to happen, and most of us are around the same age that are watching this program, most of us. I don't know if it's going to happen in our generation, but I don't like what I see. I just don't like what I see happening at the highest levels of government, where the passion for control of the economy, of all aspects of human life, just gets more and more prevalent. And this current administration is the most far left-wing administration. And I supported this in my last 2 episodes. If you don't believe me now, you want to question it, feel free to write in the chat box or send me an email, cb3@cb3.com. But I supported it with data. Number 1, Joe Biden. Number 2, FDR. Number 3, Jimmy Carter. Sorry, number 3, Jimmy Carter. Number 4, Barack Obama. All right, questions. Musk wasn't that bad. He was a bit wooden, but the sketches were funny. Well, Jay, that's being really nice. I couldn't get through them, but maybe I don't have much of a sense of humor. So I'm glad you watched. All right. All right. David, thanks. I know you're a new listener. Appreciate you joining and glad you're there. So again, guys, if you're new to the program, you know somebody that needs to be, if there's ever been a time to get a friend or a family member on the show watching, it's next week with Leo. You're just going to love it. Okay. Go to the YouTube page, have them subscribe, have them click the bell so they get updates for the Monday and the Thursday show. Follow me on Twitter. Over the summer, I'm going to be doing some more tweeting, okay, because people were responsive when the market was just hemorrhaging on Tuesday and Wednesday. I think I shot out 4 or 5 over the couple days, and I would have done more if the market had not gotten a little more under control. But Twitter's still a good medium for that. And whenever I tweet, it's on Twitter and Facebook and LinkedIn. So I have this program that basically blasts it to all 3 platforms. So as I end every program that I've since day one, I believe, from 2 Timothy, for we have not been given a spirit of fear, but a spirit of power and love and a sound mind. And that's really, really important. We're not going to let those dark forces bring us down, guys. We're just not. Appreciate you being part of this community. I really do. And I appreciate your questions and being here every week. Please, next week, guys, it's just a story. Literally, it's got to be an HBO movie at some point because I know his story. We've talked about it now. I think you're going to thoroughly enjoy it. It'll make you feel proud to be an American. We're doing it heading into Memorial Day weekend, which is a fitting time, and hope you'll join us. It's Thursday, May 13th. I'm Charles Brown, Portfolio Manager with CB3 Financial. From COVID, U.S. politics, and the world economy to clarity. This is CB3 Live, and we'll see you next week.